All right, sorry.
Welcome to tonight's second half stock market outlook. With me, as always, Charles Scavone, Chris Paris, and guys, I always think it's good whenever we come on and have these live streams when we're going through bouts of volatility, because when markets are doing really well, people tend to become complacent. So today we had a very volatile day in the stock market, and quite honestly, it's been a pretty volatile day, pretty volatile year. At the same time, though, we've had good returns, but it hasn't been smooth and the returns haven't been linear. So tonight we are looking forward to getting into the second half outlook to go through the things that we see that could likely push this market higher even further, but possibly create some. We also have headwinds that we're going to go through that could possibly derail what we see is a decent setup heading into the end of the year. So we have some tailwinds that are really structurally in the market's favor for continued growth, but at the same time, there are some things that could make this pretty bumpy. So really looking forward to going through this with you tonight. Just a couple things to get started. So we're changing up the giveaway. So instead of doing two giveaways tonight, halfway through and one at the end, tonight we're going to do the first giveaway in 15 minutes. And this is a giveaway for a $100 gift card to your favorite restaurant. But in order to register for the giveaway, you have to put a question or just at least tell us where you're listening from or viewing from in the comment section. So anyone who does that, you're going to register for a chance at a $100 gift card to your favorite restaurant. Our marketing department will be in contact with you. And then we'll do a second giveaway at the end of tonight's show, about 1 hour from now. And you have to be here to earn that one. But we're going to give away a second $100 gift card to your favorite restaurant. So those are the changes. Now, as always, we want this to be interactive. We do have some pre-submitted questions that we're going to get to kind of in the back half of tonight's show, but we want this to be interactive. So one of the reasons why I'm asking you to input questions now is so we can take those questions and have the guys discuss them and create a nice little dialogue and hopefully get some more engagement from you all. So I want to start with you, Chris, because you put out our first half outlook. This was a really cool event. So we did this at my house. So we did it, we had a little venue kind of close to my house where we did a big presentation. And then everyone who was in attendance came back to my house and we had some live music, we had catered food, we had a really, really good time. And we actually did 2 of those. So, and then we followed it up with the live stream on YouTube where we went through. So we did it 3 times. So the title of this is Sometimes a Bull is Sometimes It's Hard Being a Bull Rider. I think that's what it is. Sometimes it's hard being a bull rider. So when I first heard the title or first read it today and rethought about it from the first half, I had to think about it for a second because sometimes it's hard to be a bull rider. Oh, I get it. The stock market being a bull rider. And Chris, I have to say, I mean, you did a pretty good job as far as what the expectations were heading into this year and then what actually transpired. So talk a little bit about what you meant in the first half outlook. And this is still on YouTube, guys, if you want to go check this out, our first half outlook sometime later. What did you mean when you said the bull is sometimes harder to ride?
Thanks, Troy. So we sit down. Charles and I have been doing this, for years. I guess I'm kind of the market historian on the team. So I study a lot of cycles. Try to come up with a catchy title for it. And just so happens, 2026, when we looked at all the data, whether it's second-year presidential terms or economic cycles, it looked like it would be a volatile, at least first half. So we came up with the title. In some years, being a bull rider is harder. So, we thought earnings were going to be good, the economy would be resilient. There were a lot of pro-tax policies coming from the president and the White House that would help earnings and help the consumer. Thought that was there. However, there were a lot of things kind of behind the scenes that were little warning signs that volatility in the first half would be higher than normal. Inflation was picking up even before the Iran conflict. We saw that. I'd kind of messaged it that it got worse because of the Iran conflict, but that was kind of the spike of it. But so, the market dropped, I think it was almost exactly 10% in the first quarter. and ended the first quarter down almost exactly 10%. And then we started, I guess, to solve the Iran conflict back at the end of March, and the market like immediately snapped into earnings mode. We're going to look at, companies that are growing fast and focusing on fundamentals, and pretty much V-bottomed and rallied, off the bottom almost 21% in a straight line over 2 months. So we weren't expecting that, out of the gate, but that's the kind of move we were thinking about for the first half. Looking at the second half of this year, I tried to come up with a catchy title, and I have to say the same thing. It looks the same. Some years being a bull rider is harder, and we're going to talk about the reasons that are both headwinds and tailwinds. But I would expect volatility to continue for the remainder of the year. Hopefully not as much as it was today, but I would prepare for volatility. The economy's okay, but there's just things out there that are kind of bubbling up that create volatility short term.
And this is going to be one of the themes for tonight. So this is why we say it's so critical to have a plan. So when you look at investments in isolation, a lot of times you overweight the importance that those investments play. But if you have a plan and you have a proper allocation, investments absolutely play a role, but you have visibility across what you're doing with the other part of your assets that are not invested in equities, your income, where it's coming from, how it's not dependent on the stock market performing, taxes, healthcare, legacy. These are all things that are part of a plan. And one of the themes for tonight is going to be that volatility is it's normal, right? And some of the things that you mentioned that you were seeing when you created the first half outlook, when you stated that sometimes being a bull rider is harder than others, is you saw some things that said, hey, you know what, this might be a volatile first quarter. Or first half of the year. So sometimes the economy is fragile. Sometimes the stock market is fragile. And we don't know necessarily what's going to happen, what will transpire to maybe cause some of those fragile pieces to create this volatility. But it's not uncommon for that to happen. And sometimes it's more vulnerable than others that some event could occur that would lead to that 12%, 15%, in this case, a 10% decline. So,
and a lot of times it's just investor positioning. It's not so much the economy getting, materially worse or materially better. It's just everyone starts thinking one way. And in the first quarter, I remember going into the first quarter, the term that everyone was using, I think, in the financial press was, the run it hot economy. And the data behind the scenes was actually saying kind of the opposite. Economic growth was slowing in the first quarter. There was some pushback because of the tariff hangover that companies were having to try to pass through some pricing and stuff, and that kind of slowed some consumer spending and a little bit of indigestion, I guess, at the beginning of the year, as there generally is on some spending by companies. And that basically troughed right at the end of the first quarter, and people turned around and started focusing on earnings again and fundamentals. And we saw, tech stocks kind of explode higher, particularly in a lot of cyclical areas. A lot of the AI build out that we've talked about now for 9 months to a year. They came running back to that trade. So,
and that's going to be a second theme for tonight, and that's earnings matter. Right, earnings matter. So we have volatility is normal, and earnings matter. So Charles, when Chris put out the first half outlook and we talked about expected volatility, but at the same time we saw a lot of positive currents supporting continued market growth. We talked about earnings from corporations, we talked about economic resilience, and we talked about the expectation that interest rates would come down likely sometime in the first half of the year. So out of those three, economic resilience, corporate earnings growth, and interest rates, which they have not come down, we missed that one, where we are today compared to what we thought at the beginning of the year, which one of those three surprises you the most where we sit now?
Yeah, great question. Thanks, Troy. It probably is not just the resilience of corporate earnings or corporate profitability. It's the fact that it just continued to grow at a very fast pace. That's so critical to how we view the world and how we make fundamentally driven, earnings-driven investment decisions. Companies have done a fabulous job of really honing in and taking advantage of the three things that we always talk about that drive corporate profitability: sales, margins, and return on invested capital. And we've seen a handful of secular growth themes, particularly within the technology sector, but it's supported other areas, including utilities, energy, and some of the industrial sectors of the economy that have led to very resilient and improving rates of growth in sales. Corporate profitability has held up astoundingly well, right? And so a large portion, you hear about productivity gains, and what does that mean? If you think about it on a big macroeconomic standpoint, it's the amount of GDP you're able to get per unit of employment that you put into it. How much do you get out of the amount of labor or effort you put into it? A lot of the productivity gains have accrued directly to the corporations that are employing, streamline operations, better supply chain management coming out of COVID, use of technology to improve corporate profitability. And man, there's a lot of opportunities for these guys to reinvest in the best portions of their business. And they've just created this flywheel effect that's led to this very robust earnings backdrop that has really held everything together. And to take a little bit of a different view, although we've had all of these other issues take place, not the least of which was, a war, market's been very resilient. Why? Because it always falls back upon earnings growth.
And that's, again, getting back to the theme. So earnings resilience. Chris, I know you kind of feel the same way. Tell us a little bit about that, how you feel.
Yeah, no, I'm right with Charles. I think unless something strange happens in the next week, the second quarter will be the sixth consecutive quarter of double-digit earnings gains in the S&P 500. And I think it's either the second or third over 20%, which outside of coming out of recessions never happens. So the earnings picture has been extraordinarily strong the first half of 2026. We continue to expect it to be strong for the year, but particularly in the upcoming couple of quarters.
So in about 10 minutes, when we get into some of the headwinds that you need to be concerned about when it comes to which direction the market could possibly go, we're going to expound upon what Chris just said, and Charles, as far as earnings growth has been tremendous, but there's something happening behind the scenes that you need to be aware of, and we're going to cover that in about 10 minutes. So before we do that, and before we do the raffle, which we're going to do in 3 minutes, so if you've not register for the raffle, the way that you register for the raffle is by inputting a question or where you're watching from, where you're viewing from tonight in the chat. So we are going to get to the questions once we get through the primary portion of tonight's content, because we want to make sure we stay on track. And we also have some pre-submitted questions that are really good that we want to cover as well. So we're going to make this as interactive as possible. We want engagement from you. But in order to register for a chance to win that $100 gift card to your favorite restaurant, you have to either input your question or where you're viewing from in the chat, and we're going to do that in about 3 minutes, that first giveaway. Now, at the end of tonight's show, we're going to do one more giveaway, and in order to register for that one, you simply have to get the Roth conversion guide. So we have a couple questions here about taxes, and taxes are my domain, investments and allocation. That's Chris and Charles. So the Roth conversion guide I wrote recently, and it has a lot of good information about taxes. So to register for the second giveaway that we're going to have at the end of tonight's show, simply scan the QR code. You will receive that, and you'll also be entered for tonight's second giveaway. So, okay, Longbow Rider, how you doing? He was the first person in here tonight. Really appreciate you coming back and being here. We have some really good questions. We have Sun, we have T. Wolf, we have JT Johnson, Bobby Priester, Robert Scott from Pearland. Scott, good to see you. We have Dwayne W. Dwayne, glad you're back. A lot of people here participating. So guys, put your questions in. Oh, Barb, how you doing, Barb? We're going to get to some of these questions in a minute. We just want to get through the primary portion of tonight's content, but I want to say thank you very much all for tuning in. We do have a lot of good information, and it's going to directly impact the way you view what's transpiring in the markets over the coming months, and hopefully that helps you feel a bit more comfortable with what's going on. Okay, so we have earnings, we have interest rates, we have economic resilience that we talked about. Now, just to finish this recap, we thought interest rates were going to go down, right? We didn't get that one right. But the thing that I thought was that stood out the most about that is it just showed the dominance of earnings when it comes to stock market growth. That's why I said this is going to be one of the themes for tonight, earnings, because even though interest rates didn't come down, they actually increased a little bit. The stock market still performed quite well over the first half of this year. So what it kind of shows us, and what really has always been true, except for maybe some of those zero interest rate years where bad news was good news, is that earnings drive market growth, and interest rates, they're kind of an amplifier, right?
Very much, yeah, an amplifier or a headwind, right? And right now, year to date, they've been a headwind. They've detracted a little bit from the valuation of the overall market, but the earnings growth rate has overwhelmed it, particularly in certain sectors. So overall, I think with today's decline, the market might be up around 8% year to date.
Sounds right.
I think it peaked at around 10 and a quarter a couple of days ago. But all of that is earnings growth of the S&P 500. There's no PE expansion year to date.
So
But it points out to why I think it's important that we highlight why we create these outlooks is so that you have a roadmap and we have a thought process on where we believe we're headed. But what we do differently than a lot of other folks do, we hold ourselves out as active managers. So we're always trying to optimize the invested capital that our clients give us by, number one, adhering to I believe, a thoughtful, disciplined, process-driven approach that's focusing on corporate profitability and earnings. And that framework allows us to manage money, and it is what's sort of our North Star over economic booms, busts, war, COVID, bubbles, you name it. And if you need to have that in place so that at least it gives you the best opportunity, the best chance to deliver consistent returns over time. Otherwise, you're just chasing whatever around, I believe.
We used to have this piece on the website, and it was titled, "I Shouldn't Invest Now Because," and it went back to like 1935 or something, and it just said all the major geopolitical or economic events that happened in that year, and right next to it was the level of, I think it was the Dow Jones. And year after year after year after year, you see, you see everything that's transpiring, World War II, the Kennedy assassination, all of these different things over time, and you just see right next to it, the market keep going higher and higher and higher and higher. So my point here is that there's always something, and it comes back to earnings. It comes back to corporate earnings. And part of being invested, the price of admission, is volatility. Right? But we need to make sure, especially in retirement, that we have the appropriate amount allocated to stocks, because the price of admission is volatility. So if you have too much, you can make mistakes. If you have too little, you may not get enough growth. But part of it, the process, is actually also accepting that there is volatility. And that is just the price you pay to achieve long-term growth rates. Real quick, Charles, we have the winner of tonight's first giveaway is T. Wolf. So T. Wolf, thank you very much for inputting your comment. So his question was about taxes. Which thresholds, what are the primary taxable income thresholds to minimize taxes on retirement income? So the ones you need to be aware of are Social Security tiers. So those thresholds, Social Security is a preferentially treated source of income. Right now, you could have over $90,000, close to 100, maybe even over 100 now, of Social Security income and pay zero taxes if you don't have other sources of income dragging it into a state of taxation. So be aware of the Social Security thresholds, the capital gain thresholds, the dividend tax thresholds, the IRMA thresholds, and of course, the income tax brackets and what we talk about, the income tax torpedo. So those are all other videos that I've done on this channel. We're not going to get in them tonight, but T. Wolf, thank you very much for asking that question. That's a quick primer. Hopefully that gets you going in the right direction. And we're going to do one more giveaway at the end of tonight's show. So, Charles, I'm sure you were about to tell us something very important. You may have forgotten by now.
What I was going to say. No, I'm just kidding. I'm just kidding. But you made me think. One of the things we were talking about, it's so important now. Why active management matters now is that before we talked about when interest rates were at a point in time where interest rates were at zero or near zero. That one factor that we talk about a lot, return on invested capital, is sort of infinite. When you have free money, right, you can invest in anything. Now that paradigm has shifted where interest rates we talked about are higher. They're a bit of a headwind, but they're not an impediment. But they're high enough now to where investors are rightfully differentiating between the types of companies that are afforded the highest valuations in the market, and that's because those are the sharp managers, financial managers, business managers build moats around their companies that allow them to earn a much higher return on that invested capital, which is no longer free. That has been a big, big paradigm shift in the market.
Chris, expound upon that a little bit.
I mean, it's zero interest rates. People can do kind of crazy things with money. It's, infinite possibilities of what can invest in. And rates are now, call it 4.5%. So old rule of thumb, I was taught under years ago, take the 10-year interest rate, 1 over that. That's about the PE of what the market should be. At 4.5%, I think that's 21.5 times earnings, which is about where the market is right now based on the earnings projection for 2026 without growth. So, if we were to cut it off right now and say, I think, what are the estimates for the year? 345?
Almost, not quite 345.
So 345 times 21.5, and you're in the 7,500 plus range, but that number looks like it's going to probably be low because the numbers keep moving up here for the second and third quarter and the rest of the year. So, people get into arguments about we're overvalued. Valuation is a horrible timing tool. It will not get you in the market. Well, it won't get you out of the market, right? It might get you in the market better, but there are no great valuation tools for market timing.
Yeah, that is a tremendous point because it's something that I think I just want to spend a couple of minutes on here because there have been a number of short sellers that have gone broke over the years because they correctly identified that something was extremely overvalued, but the timing was off.
Yeah.
And there's a whole lot of people that find undervalued investments, but maybe the timing isn't right. And they stay undervalued for 10, 15 years. Yep. So I love that you just said valuation is, what did you say? Evaluation
it's a poor market timing tool.
Market timing tool, because something can be over or undervalued for very long periods of time before the market decides to recognize that price distortion.
Yeah, in fact, the best returning stocks over time have always looked overvalued, whether it was Walmart early on or Starbucks or Microsoft. Yeah. And because the earnings look, it just looks too expensive, right? I think Starbucks traded at 35 times earnings for 10 or 15 years. And everyone would look at the earnings and it would trade at 35, 50 times earnings. Like, oh, that's ridiculous for coffee. But if you drill down into an actual Starbucks store, they would get cash and they would go reinvest the cash. They weren't paying a big dividend. And each store that they put up was returning 35 to 45% per year cash investment, cash back in the door. So the market was pretty smart to say, hey, I'm going to let Starbucks compound my money for 10, 15, 20 years, whatever the number was. I can't even remember. And then, of course, it starts to slow and earnings look okay, but that cash on cash return peaks because I'm going to go international and it costs more. And, the stock might go nowhere for years. And that's where people go, oh, see, it was overvalued. It was discounting it all. It's just that marginal cash investment is declining and the stock market hates that.
Amazon's another story, right?
Yeah.
You know, for years, Amazon had no earnings, right? But it kept, reinvesting,
Exactly.
growing revenues until eventually it became profitable. And, so point being is I just like the concept. And I think it's important to understand because I think a lot of our clients and many people watching do believe in what's that Warren Buffett school of investing. And the thing about Warren Buffett and that style is that, he had an infinite timeline, right? When you have billions and billions of dollars, you can wait a very long time for the market to prove you right. When you're in retirement and you're generating income, you don't have that same luxury often. Now, maybe you do. Your circumstances may be different, and possibly you have X amount of dollars where you can, wait 10, 15 years for the market to prove you right. But it's about growth.
Yeah, and Warren Buffett, I mean, he had billions of dollars every month coming in, and he can just let it pile up. Versus a retiree, you don't have that luxury. You generally don't have a lot of income coming in. So, everyone looks at Warren Buffett. It's a totally different business model.
Yeah, completely different.
If Chris and I spent 10 years with stocks that did nothing, we wouldn't have been here for 10 years. Troy would have been looking for different investment managers.
Okay, so Charles, I want to talk a little bit about how everything we're discussing ties into SMR, but we really got to get to the framework for the second half outlook. So we have some headwinds and we have some tailwinds. I want to talk a little bit. What I want to do, instead of doing like the 3 tailwinds, so things that could help, and then the 3 headwinds, I'm going to go one by one here. 1 tailwind, 1 headwind, back and forth. So what are some of the tailwinds? Just pick one and let's discuss it.
Corporate profitability still looks very strong for the next couple of quarters, and so that's the linchpin of what's going on. Everything else think about it this way. So that's your core. That's the core premise that's holding the market where it's at. Some of these other factors that we looked at may be what did we say?
Headwinds.
No. We came up with resistors.
Oh, yeah.
Resistor accelerates. So
amplifiers and
resistors. So corporate profitability remains very, very strong. We'll be listening to a lot of conference calls. We're about to end the quarterly reporting cycle, and we'll be listening to what companies did, but more importantly, we'll be listening to what those outlooks are to see if these trends are continuing to accelerate.
Okay, so corporate profitability. Getting back to this theme around corporate earnings. So corporate earnings drives stock market prices. So that's one of the big things that are still in favor of this market continuing to go higher. And again, accepting that volatility is the price of admission, right? Some years, volatility is much smoother and it's much more comfortable and you don't worry about what could happen. But this is one of those years where to invest in the market, you have to have, a little bit of a stomach. So, okay. So good news is the same primary driver of the stock market performance over the past, let's say 6 months, just isolate that time frame, is still in existence today and is still likely to drive the stock market higher, potentially drive the stock market higher over the coming months.
Yes, exactly. Well said.
Okay, so Chris, now what about a headwind? What's something that could counter Charles's point about earnings growth?
It's on the same thing. It would be peak earnings growth. So far, looks like it'll probably be the 3rd quarter of this year.
Okay, so let's define peak earnings growth.
And that's rate of change. So
okay, let's define rate of change.
So yeah, in the stock market, the stock market rewards. I mean, bad goes to poor, goes to good, goes to better, goes to great, right? It doesn't reward great goes to good.
Yep.
And it has a really hard time because then it thinks good goes to mediocre goes to, it extrapolates linearly. And right now we're growing earnings, not exponentially, but at an accelerating rate. I think 4th quarter was in the high teens. 1st quarter was 20.5% or something like that. This quarter is supposed to be 21.5%. And then you get to the 3rd quarter and it's in the 23.5%, 24% year over year rate of change. But then you get on the other side of that, and it starts to slow down, just because the comps get harder. It's just hard to grow earnings in an economy at 20% plus.
So to Charles's point, corporate profits are still growing.
Yes.
But to your point, they're not growing at the same rate that they were previously.
That would be the projection for the third quarter would be the peak growth rate. Therefore, the fourth quarter would be a slowdown in the high teens.
Yep. Yeah. So imagine, let's say you own a private investment and it's a business that you run. Let's say it's a small company that sells widgets, and you have 20% growth this quarter, 22% growth. Let's take it 4 quarters ago. You have 20% growth. Then you have 22% growth. Then you have 26% growth. And then this past quarter, you had 24% growth. So that rate of change, you went from 26 to 24. Even though you still grew at 24%, the stock market is saying, hey, guess what's happening here? They went from 20 to 22 to 26, now 24, came back a little bit. The stock market cares about that rate of growth, and that's what could potentially lead to some volatility in the second half of this year.
Exactly. Yeah, that's, and the stock market historically is a forward-looking mechanism at the bottoms. People are like, the economy's horrible, earnings are horrible, the stock market bottoms, and it usually goes up for 6 months before the economy starts to turn, before anyone reports any good news on an earnings call. On the other side, towards more peaks, whether they're for a year or just for for a few months or quarters, it tends to be coincident. It kind of waits until you're almost going to report the best numbers out there. And then people say, hey, is that repeatable? But they like to see the good news before they say, is that really the best it gets?
And we talked about earlier about valuation being a poor market timing mechanism. Economic news is also a poor,
yes,
market valuation,
very much
indicator.
Go back and look at the first quarter. If you turned on TV, you would have thought the economy was booming. Meanwhile, the stock market was already rolling over before the Iran war hit.
Yeah,
it was just slowing down. It wasn't bad. It was just slowing some.
And we talk about this all the time. Most of the data that you see that is on the nightly news, which is on the talking head channels, the government data is old, right? It's what happened over the past 30 days, 60 days, 90 days. And the stock market is already digested that like 6 months ago, right? When you hear economic news like job report numbers, it may have a little impact on the daily fluctuation. But in the grand scheme of things, the economic news is a poor market valuation and timing tool.
For sure. And the media, they pick up on what's been reported, and they look and see what's happening on the stock market on a given day and try and meld those two together in the best headline possible, because they're journalists and not investment managers.
Yeah. Okay, so Charles, what about another tailwind? What's something that could drive the market higher in the second half of this year that we see?
Lower energy prices.
Yeah, thank you. Lower energy prices, obviously, particularly you think of just about it on the most simplistic terms, at the price of gasoline, at the pump is effective. We all drive, particularly in Texas. And to the extent that the price of a tank of gasoline is going up, that's taking money out of your pocket for discretionary spending on other items. So a lot of folks have been forced to reallocate to different, more necessities as opposed to wants. So that has a very, it's almost an imputed tax on the consumer. We've seen now that energy prices or crude oil prices have come off 30% since, and that was even before peace or some sort of a peace agreement had officially been agreed upon. So certainly falling energy prices could be a bit of a tailwind.
And I see a lot of these articles that talk about there's going to be some type of big delay in the drop in the price of gasoline and how that flows through to consumers' wallets. Historically, there's been some delay, but I don't think too tremendous of one. Any concerns there as far as the delay in this hitting consumers' wallets?
No, I mean, peak driving season is 2 weeks away, July 4th. That's usually peak pricing for unleaded gas. The higher prices are going to create, a demand slowdown, which gets pricing down, and then pricing comes down, and people will use it more. So it's a commodity, right? The biggest, what's the saying? The best way to combat higher commodity prices is higher commodity prices.
Yes, sorry. Yep.
It's higher prices.
It's
and that's what
self-correcting.
happened, right? I mean, the demand destruction hit in fuel, and it'll pick back up. When hopefully it helps consumers, in the third quarter, and then they start to look towards maybe spending for the holidays and Christmas and stuff. So they're like, okay, I got some money back in my pocket. We've already kind of gone through the pluses of the tax refunds from the Trump tax plan. That actually was kind of offset by a lot of the energy prices because they happened almost at the same time. But, lower energy prices is a good thing for the consumer.
Yeah, because ultimately lower energy prices means more money in people's pocket, which means more people spending, purchasing goods, purchasing services, and contributing to earnings growth, which is the ultimate driver of stock market performance. Okay, so we have lower energy prices, we have corporate earnings as two tailwinds from Charles. The rate of growth slowing in corporate earnings as a headwind from you, Chris. What's another headwind that we should be aware of that could cause the market to be quite choppy moving forward?
Headwind would be not sure with the new Fed chair, what's he going to do? He clearly is going to change the messaging profile relative to Jerome Powell and relative to the last probably 20 or 30 years. He's a disciple, I think, of Greenspan, who just passed away. And, less information, less talking economists on TV, I think, is what Warsh is going to go for. The good news is, at least for us, hopefully, is he actually was involved in the financial markets with tradable financial markets, not as a lawyer doing private equity for a few years. So I think the data that he's going to look at will be more real time and less these, 6 weeks to 8 week old government data that's revised, 10 times and people ooh and ah over it. And it turns out to be meaningfully wrong. So,
okay, so new Fed chair, there's
and some
uncertainty there
well,
regarding what they may do.
Too. Yeah, and they're usually tested. In the history of new Fed chairs, I think the last 7 of them have been tested by the financial markets somehow, whether it's an inflation scare, a growth scare, some shock overseas. I think, they've all been tested. Markets have declined anywhere from 7 to, double-digit rates, over 20%. Whether it's a coincidence or not, expect probably later in the year Warsh to be tested some kind of way. We can guess it why.
If for no other reason, merely the fact that there will be less communications in between meetings means that when the meetings happen and interest rate policy is made, there's going to be more volatility. There's going to be more variability to the potential outcomes of what happens, and that in itself will create volatility. I think it is a great thing, though, that he's going to rely upon more accurate data for making very important decisions, because the risk is that he makes a policy decision is the wrong decision to make. And if it's predicated upon the use of bad data, then that would be, that would be terrible. But I think the other thing that he's already created some volatility, the fact that the expectation was he was, very much handpicked by Trump to come in and lower rates, and he clearly said that he wants to maintain Fed independence, which is good for all of us at the end of the day. We've talked about that before. And like Chris said, just the fact, though, that he is more versed in the operation of capital markets and how that their message, the transmission mechanism needs to be proper.
The probably the ultimate determining factor will be his persuasion skills.
Yeah.
You know, he has a lot of academics on the Federal Reserve Board. Not many people who have actively been involved in large capital allocation decisions outside of their kind of ivory towers. And it's his persuasion ability to take that real-time economic data that he would also probably use in some of the money management, private sector there, and introduce that to the Fed process instead of just looking at the antiquated government data and making moves based on where the economy was, and understanding that this is, you talk about, when you want to steer a ship, right? A huge ship, it doesn't just turn on a dime. You have to get that baby going, in a direction early.
Yep.
So it just moves a couple quarters of a degree, in a new direction. So hopefully he's able to take some of this information outside of government data and use those persuasion skills to help people see it, maybe from a different perspective. So that's my take, at least.
Yeah.
Okay, so a couple things. We have some questions we want to get into now. I don't want to spend more time going through these tailwinds and headwinds. Just real quick, got to go through them when in just a couple of minutes, the last two. We're going to have a giveaway. The giveaway we're going to do is at the end of tonight, the show. And in order to register for that giveaway, you should see a QR code on your screen, and you're going to receive two things: an entry into the giveaway, but also you're going to receive a Roth conversion guide. So I took probably about 10 days or so to put this together. It has a ton of good information, and it has our perspective, but a lot of concrete, good information for you to learn about Roth conversions, learn about potential tax savings, and learn if it's something that maybe you should consider. Of course, always consult a CPA, consult an advisor, but if you're looking to learn, the Roth conversion guide is a really good one for you to download. So not only will you register for the giveaway, but you'll receive that as well. Okay, so I want to get into some of these questions, and we have some pre-submitted questions. So quick, Chris, just really briefly, let's discuss the last tailwind and the last headwind, and then we'll get into some of the questions because we have some really good ones here.
Yeah, the last tailwind, was it GDP growth being
Or
better than
interest
expected?
rates.
Interest rates.
That's right.
And then also the slowing CapEx spending possibly, or at least the expectation of return on those investments.
Yeah. So interest rates have gone up, I think, about 35 basis points on the year. At first, it was in the inflation component, and the growth component was going down. Now it's the growth component's going up and the inflation component's down. Overall, interest rates are up 35 basis points. That's a headwind, but it's not a roadblock, right? It's just keeping the PE compressing. GDP growth is good, getting better. Job growth is okay. Those numbers are overstated because of the types of jobs that are being created, but it's still a decent job market overall. So that's positive for the second and third quarter. And then on the negative side, all this money that's benefiting tech, a lot of the tech names in semiconductors and optics and energy companies that is being spent on building out AI, it's still unknown what the cash return is going to be from these tens, if not hundreds of billions of dollars. And it's been going on now 3 or 4 quarters at an accelerating rate, and the market's getting a little edgy about, how much money is Microsoft going to make, or Meta going to make on, or Google on these tens, if not hundreds of billions of dollars of CapEx. So that can become a headwind later on in the year because the numbers are so big, and if nothing else, they become difficult comparables.
Investors only have so much patience.
Correct.
Right? If you're going to spend $100 billion of investor money, right, then at some point you need to start generating some returns on that capital.
Unless you're Elon Musk.
Very good
So
point.
unless you're Elon Musk. So I did a SpaceX video. Chris, I believe you did a SpaceX video. And we've got a ton of questions about SpaceX. We actually should touch on it for a little bit here. But, the interesting thing about SpaceX is, well, for me, the interesting thing is the amount of patience investors will have, because the entire thing is a bet on future earnings, but we're not talking about next quarter or next year.
Right.
We're talking about 2, 3, 5, 10 years from now,
At
things
least.
that the company may do. In your guys' career, maybe there was something in the .com era, but have you ever seen something so hyped, something where the expectation of changing the world, being so insanely profitable, ever came across your desk?
I've never seen the street give a hall pass as big as this one. Not that I can recall. I mean, Jeff Bezos had a wonderful idea, right, for Amazon, and took that from selling books to creating a platform company, right? This platform was an operational giant that could distribute all sorts of goods. Well, that took a huge amount of capital investment. He almost went bankrupt before he began to realize the operating leverage of this thing. But stock went, to single digits. I mean, it was near death experience.
It was
for the guy.
97% or something in
Something
the
like
.com.
that. Yeah. So now you take everything that we've talked about in terms of drivers of stock price being corporate profitability, right? Okay, so you're a growth investor. What are you buying as a growth investor? You're buying an expected future stream of cash flows and earnings. Okay, and so that's what we focus on. So then you take a look at what SpaceX is, and you look, okay, well, is sales growth even growing? No, it's actually decelerated considerably. The margins have gone down and are negative and are becoming more negative because of the amount of capital that's being spent. And as a result, the return on the invested capital is very much negative. And he just did another $25 billion in debt again today to raise more capital. And so when we as an investor are looking to allocate clients' money, we're looking for companies that generate a return on that invested capital. They're not consumers of that capital.
Yeah.
Right? And that company is a massive consumer of capital. And thus, it doesn't fit the model that we use. And we get a lot of questions. We're not here to offer investment advice on specific stocks. That's not the business that we're in. But I would just tell you that for the reasons I just mentioned, it doesn't fit the model of what we're looking for. It's hard to really wrap your head around it, put pencil to paper and pencil out what it's worth. For those reasons alone, there's a whole other litany of corporate governance issues that should also raise a lot of questions. The other thing that people just seem to be confounded by that is important that folks realize is that, well, who's making the money on the SpaceX deal, right? I want to be involved in the IPO so I can make $1 billion. Well, that's not the way the game works. What has effectively happened here is a massive transfer of debt to equity from the value of this company has been provided to the original founders. The private investors in the company have absolutely been cashed out by everybody who lined up at Schwab and Fidelity and whoever it may be to buy a share of SpaceX.
Not just the founders, but the employees, anyone involved with SpaceX because they receive shares, right? So you're absolutely right. The lion's share went to the early investors, the people who invested, millions of dollars, tens of millions, hundreds of millions, billions. But I thought one of the things I did think was cool is I saw something, I don't know, it was a headline, so I didn't read the entire article, but there was a certain number of cafeteria workers that are now like millionaires.
Yeah.
Just a feel-good story.
Yeah. Oh, yeah.
So that is pretty cool. I think it's safe to say that SpaceX does not meet our criteria for growing sales, expanding margins, and increasing returns on invested capital.
But that doesn't mean that we can't benefit, or our clients can't benefit from what's going on with SpaceX, because we just talked about this huge amount of capital expenditures that they're making to build this terafab, to build all of their AI stuff. We adhere to the same old story. It's getting tired now, but the picks and shovel approach, right? We would rather, from our perspective, it's a much better risk reward opportunity to invest in the companies who are the recipients of all of this capital spending, as opposed to investing in the company who's doing all the spending, to, as you said, Troy, is very much, Chris said as well, very much uncertain as to what the returns on that investment will be.
Yeah, I mean, look at it quite simply, right? If SpaceX is spending $50 billion, somebody has to be receiving that. Somebody's sales are growing. Somebody's margins are expanding. Some management team is taking those profits and reinvesting it into the things that SpaceX wants, return on invested capital. So people are benefiting, and it's not just one company or two companies, it's dozens of companies, hundreds of companies, thousands of companies. And those are the ones that we feel have a more, what we would call, asymmetric risk return profile, meaning you're taking less risk because they're not taking on all the debt. They're not taking on all the
technology risk, or market
everything,
acceptance
the spending risk, everything else. They're accepting that cash from the consumer of it, SpaceX, and those are the companies that we feel have lower risk, higher expectation of returns. Chris?
Correct.
Yeah, the only thing I have to add is that, I think people have gotten so excited about it, they forget that SpaceX is really three companies. And, two of them, when they were private, were essentially monopolies. Starlink was essentially a monopoly. And SpaceX, was a monopoly that even Elon said he didn't think was going to work, right? And SpaceX has been... The rocket company's been in business, 22 years? Or
Has
almost
it been?
Yeah,
It's been a while.
It's an amazing amount of time. So it's just been in the last couple of years when he bought Twitter, and then he bought Grok or XAI. That's where all the money's going. And those are not the leading companies in the field, right? He's trying to play catch up and spending a lot of money to do it. And as a public shareholder at a $2 trillion valuation, when the valuation, I think, was $500 billion 6 months ago, it just doesn't make sense.
Okay, so we have tonight's second giveaway winner. So we still have everyone's questions to go through. So I tell you what we'll do. We're going to do this second giveaway winner right now. And we have some pre-submitted questions, but you guys have input a lot of questions into the chat box here. I want to go for about 15 more minutes and answer your questions, make this an interactive opportunity. So we'll do one more giveaway. So in order to register for this one more giveaway, again, it's the Roth Conversion Guide. You should have a QR code on your screen. But the second winner for tonight is Tina Johnson. So Tina, congratulations. Our team will be in contact with you, and we'll deliver that $100 gift card to your favorite restaurant. And as I said, we're going to go through the questions now. We want you guys to be interactive with us, and we'll be interactive with you. And in about 15 minutes, we're going to do our final giveaway, and then we're going to close out tonight. So before I get into the questions, guys, in a couple sentences, what's the expectation for the second half of this year? I'll let you, Chris, you looked over at Charles. So Charles, I'll let you go first here.
I'll have to get out my coin for no, I think, I think the overall environment looks good. There's an opportunity if a few things go right. It could be great, but risk is ever present, and we need to be very cognizant of that, and try and do as best we can to adhere to our discipline, be tactical in nature, and just make sure we're following the numbers, following the data, following
Stick to the process.
Stick to the process.
Have a methodology, be disciplined about it, and put your head down and let the rest take care of it.
Keep our heads down, stay focused, put up the numbers, everything else will take care of itself.
Yes, sir.
I have to answer the question.
That's why you're
I
up
think
here.
it's more of the same, except it might be. So we're in the second year of a presidential cycle. They're usually the most difficult of a 4-year cycle. This is proving to be a roller coaster. I kind of expect more of the same, with it likely to be kind of a mirror image, unfortunately, of what happened the first half, which based on earnings and stuff would be a pretty strong third quarter, followed by some more volatility in the fourth quarter. It's just historically the way these second years work. It's also happens to be the way their earnings are kind of lining up. So, more of the same volatility. But Charles and myself and Dwayne and the rest of the team have been through these kind of environments before. We have 3 tools to help our clients, and using those 3 tools and our collective knowledge, we should be good.
Yeah, and it's one thing for me to kind of listen to you guys go through these, and I think it's really, really important. But I think for if you are a client, if you're not a client, to hear some of the big takeaways, because what we're ultimately trying to do is to help you feel comfortable with your allocation to equities and retirement. So no one's ever went bankrupt from owning a bad investment. They've went bankrupt from owning too much of a bad investment. So this is where position sizing, this is where asset allocation, this is where understanding your willingness to take risk, to see those accounts fluctuate up and down, where that needs to be identified and then put into a structured plan so that you have the growth expectation to generate income for as long as you need, but also you're not going to bail when markets get difficult, because the theme of tonight is earnings matter and volatility is real. And none of that, from what I'm hearing you say, Charles, from what I'm hearing you say, Chris, is going to change over the next 6 months. So what we expect is continued earnings growth. The big concern is going to be, does the rate of earnings growth decelerate, which could cause some type of sell-off, and volatility because of the various factors that are ongoing and being in, let's call it a late stage of a bull market, is normal. Is that volatility something that you can withstand? Because we've got a lot of questions. We got them pre-submitted. We have them in the comments. Should I sell now and get out and wait to come back? And this is where the plan matters, right? If you sell now, what you're ultimately saying is you're guessing right now, and you're going to be able to guess right a second time on when to get back in. And we all know that's unlikely to happen. So the probability of getting both of those right is extremely small, and over long periods of time, you're most likely costing yourself money. And Charles, I want to let you respond to this one first, but I want to first say this, because this is important. Do you know what the difference between gambling and investing is? So think about it for a second. What's the difference between gambling and investing? The longer you invest, the more likely you are to win. The longer you gamble, the more likely you are to lose. So volatility is to be expected, but have a proper allocation to equities as part of an overall plan. Know where your income's coming from, make it durable, make it predictable, make your income growing, and of course, make it liquid. Replicate that paycheck in the retirement phase, the thing that made decisions that were financial in nature much easier when you were working in the accumulation years. Replicate that in retirement and allow the stock market noise to not bother your quality of life. That's the secret, and that's what we do here at Oak Harvest Financial Group. So, Charles, when we talk about some of the questions here, we're going to just put a bunch of them into one. Some of the pre-submitted questions, some of the comments here. What is so difficult about getting out when people feel that the market is volatile or they feel it may go down? Why, in your experience over many years of doing what you do, is that unwise because the unpredictability of markets?
Yeah, well, it tends to be emotionally driven, number one, and it's not based upon reliable statistical objective indicators, which is what we tend to look at. Chris and I can take a step back and take a very objective look at what's going on. But as an individual who sees maybe the value of their account fluctuating a lot, that becomes a very difficult emotional decision for them.
Or watches the same news program every night.
Yeah.
And they see the headlines every single night. Or even if it's different news programs, those are things that are meant to tug on the emotional strings. And those things, the same things that make you uncertain about your portfolio, are the same things that keep you tuning in to that same show every single evening or every single morning.
Sure. I spent a lot of time thinking about the elements of behavioral finance, and we sit in it's just an incredibly interesting intersection of how people think and how people behave. And again, it boils down to the value and the importance of having a human being as a financial advisor as opposed to, some crazy, AI generator or whatever, trying to provide investment advice. You need a person that's got experience that can help guide you into not making irrational, emotional decisions. Chris and I are just in the back. Chris and I work in the kitchen, making the best possible, meatloaf, mashed potatoes, green beans, whatever it may be, that to achieve a particular function, figuring out and talking with the client how much of each of those, and they're all different, all the clients are different, how much of those should be used to create the meal for them. Yeah. And so we can take a step back and view it very objectively. And I think, and then having a person to kind of help guide you through that process and understand what their plan looks like is just an incredibly valuable aspect.
Chris?
I would just ask for all you who are contemplating that, do you have a successful career in investing doing it, right? Every time you've thought about pulling the ripcord and going to cash, did you do it? Did it work out? Did you get back in? What did the market do the next year? What did it do the next 3 years? Because I've met very few people who ever could get both decisions right. And most of the people I ever talk to are calling when volatility is super high to make changes, and they want to move out, which from a pure data perspective, and right now this is not high volatility. This is actually normal volatility. Yeah, VIX at 20, 21 is normal where it is for the last 30 years, right?
What I would want you to do is dissociate the things that you hear on the news to what actually happens in the portfolio. If you can mentally separate those things, because they're two different things, right? Just because, we're at war with Iran, that's not impacting NVIDIA, right? It's not impacting the CapEx spending that all of the companies that SpaceX are deploying that capital to. It's not impacting them. So the stock market cares about earnings. The news is something completely separate. So yes, there is some, of course, possibility that one major news event causes the portfolios to go down because the reason would be because earnings are expected to be impacted negatively.
And at Invesco, we used to see, my back office would call and say, hey, you're going to see, and it would be, $250 million come into the fund today, and it's market timers, because they would be identified. And they were always exactly wrong. So you would have institutions that were trying to do this as well, and they would always be exactly wrong.
Okay, so let's get into a couple more questions here. First and foremost, we have a couple people I want to say hello to. So Mark, 8208, good to see you. Scott from Pearland, I think I mentioned you earlier, but Scott, always glad that you show up every time here. Really appreciate it. T. Hughes, we have Hayden Bourne, we have John Hunter. Guys, thank you very much. Okay, so this is an interesting question on what we've been saying, I guess. Sun says, what do you think the primary drivers are for such long periods of corporate profitability? So outside the box here, not sales growth, not margin expansion, but what?
Well,
A large part of the driver for it now has been this secular shift towards, first was cloud computing and now AI, and the infrastructure, the massive amount of infrastructure necessary to support that. And it touches upon a lot of things that people forget about, not the least of which are, earth-moving equipment to build a data center, right? The heating, ventilation, and air conditioning, the electricians that are needed. It supports an entire supply chain. It is big enough to move the needle. That amount of capital investment drives GDP growth. The thing that's interesting is that there are now in place a number of companies who are large enough and who generate so much cash flow. We're talking the MAGs, we're talking, Amazon, Microsoft, Alphabet, Meta. They generate so much excess cash flow that instead of repurchasing stock or letting it sit on their balance sheet, they've been investing that money. And it has moved the needle for a whole number of industries that have a very meaningful impact on overall GDP growth, corporate profitability, and the like.
Yeah, over the last couple of decades, it's been the use of technology, right? It's just how we're using it in new ways to lower costs. It might be, instead of everyone having a printer with their PC, we figure out how to network printers, which is actually the first use of networking in corporations. So instead of having 1,000 printers at IBM, they had one printer on every floor, right? And that cut down on expenses. Now it's being used, to reduce, in certain areas, the number of people working in certain areas that can be replaced with AI, and the job formation is going away from some of those software programming jobs, but also going in towards more blue-collar, high-paid electrical jobs. So technology and the way humans use it, is shifting around expenses and costs and driving revenue for other companies. So
and it's been generally deflationary in nature, and so that's kept inflation low. And that's been helpful as well. Yeah. And it's improved margins. So.
Yeah. Okay, so I want to acknowledge Lewis, who is also on here, is one of our most active participants. So Lewis, I didn't see a question from you, but if you do have one and you're here, go ahead and put it in. We'll answer it. We have a pre-submitted question from a client, and then we're going to do the last giveaway here. Just commodity prices. So gold and silver, gold's had a tremendous run up. We're seeing some, shifts in commodity prices. The dollar's starting to do well after some time of poor performance, relatively speaking. What's going on outside of oil in some of the commodity space? Because I know a lot of our clients and maybe some of you watching are interested in gold and silver and these things.
Near you.
Well, so let's hit gold and silver. So precious metals to start with is probably much of a currency play as anything else, and a rising dollar generally depresses gold prices, and it has to do with central bank demand and how they try and manage their currencies. And so although we would probably tell you that the longer term outlook for gold and why it makes sense is still in place, the tailwinds to create a continuing increasing rising price right now are probably not in place. So the case is not quite as strong. Industrial metals, on the other hand, if you've listened to what we've talked about so far, you can understand that things like copper, other industrial metals, the demand for those are very strong due to not only just regular industrial growth, strong, growing economy, but the incremental demand from data centers, electricity, the utility grids are driving strong demand. The other thing that's kind of interesting is, commodities, particularly industrial commodities, become a national or a strategic initiative by countries to preserve for their own use, as opposed to where a lot of times that would be exported and these markets were more open. Now, sort of he who has the commodities, particularly rare earths or things like that as an extreme, has a
it's part of the SpaceX story.
They have
mining.
some, but additional
meteor mining.
Meteorite mining.
Who knows, man?
I mean, I guess it's very well possible. It's just it's not next quarter.
Yeah.
Right.
Yeah.
And that's part of the SpaceX story is, there's an infinite amount of rare minerals that company may have access to. And it's possible. It surely is. But it's not next quarter or next year.
Maybe the folks at Caterpillar are working on some sort of a lightweight,
it's a future partnership
contained, self-contained mining equipment.
Chris, give you a couple of final thoughts, and maybe if one of you guys want to talk a little bit more about the potential for rates to continue to increase. We're talking about, I don't want to get into real rates, but just the 10-year Treasury, but then also an increasing dollar, because I think these could be headwinds into the second half of the year. So any final thoughts? Then we're going to do the giveaway on anything that you have to say, and then talk just a little bit about the strengthening dollar and what happens if interest rates go higher.
Yeah, no, great points. Those are two headwinds, right? A stronger dollar from a consumer standpoint is great, but from a financial perspective, the markets don't generally like it because it's a headwind to earnings, because so many of our companies sell products overseas. The dollar is going up right now, largely because we're one of the best economies in the world. Ourselves, Taiwan, Korea are growing faster than everyone else, so money comes here. But that's a headwind to precious metals. It's a headwind to overall industrial commodities because they like lower dollars. And as far as interest rates, same thing. If interest rates, because either our economy is too hot and people think they're going to raise rates, which is kind of what people are talking about now, or if it's back in like the first quarter and inflation was running up, either one, if overall nominal rates inch closer to 5% on the 10-year, that's bad for overall stocks because you're discounting your valuation. Now, instead of that 21.5, 1 over 0.05 is now 20. So you're just getting multiple compression, even though your earnings are growing.
If we had 5% the 10-year, I wouldn't be shocked if we saw an 8-10% correction.
Or more.
But you have some numbers there, Chris. So I want to put this into perspective. So an 8% correction in the market, a 10% correction, a 20% correction. These things are fairly normal. So Chris has some numbers. We just want to go through these numbers, give Charles a final word, and then we're going to announce the final giveaway winner.
Yeah, and these are I'm giving creative planning. These are their numbers. So, and I have looked into them. They're great numbers. So, minus 10% declines in the S&P 500 once every 1.5 years. Okay, minus 20% once every 4 years. Minus 30%, which is essentially a recession, once every 10 years. And the dreaded, your money gets cut in half, is once every generation, once every 50 years. Once every 48 years, your money gets cut in half. And still, the market's at new all-time highs and is compounded over very long periods of time at double digits because earnings and the ingenuity of American companies to grow revenue and grow earnings over time. Yeah.
But again, coming back to planning, if you have X amount of dollars and you need to generate $100,000 a year, you may not need 70% in equities, right? So how much growth do you need to achieve the income that you want to generate in retirement, given all the sources that you have, all the assets, and the tax ramifications? Because generating $100,000 that's taxable and $80,000 that's tax-free, those are two different things, right? So it doesn't take as much of an asset base to generate $80,000 as it does $100,000. So tax matters. That's part of the overall planning process here. So understand those concepts.
And one other thing, all equities aren't the same, right? I mean, growth stocks aren't the same as dividend growth stocks. And all you have to do is look to 2022, right? I mean, the NASDAQ went down 55% or something like that. S&P,
not quite that much.
Well, the S&P on an inflation-adjusted basis was down 35% peak to trough. I think dividend stocks were down at the bottom, maybe down 12 or 15, and closed down 7, right? Because you had that dividend stream coming in, giving you some cash, or you could buy it, put it back in stocks. And it just provided some ballast versus trying to buy all the high flying stocks that are growing 20, 30%.
You know what the number one thing is? It just kind of hit something really important, I think. So we put plans together, right? We have an investment strategy, we have an income, a tax plan, all of that stuff. But the tools that we may use dividend stocks in that plan. Dividend stocks have less volatility, but they also have less growth expectation over time. But they provide increasing income. They provide tax advantages potentially if they're in non-qualified accounts. We also have growth stocks. Growth stocks are more volatile. They have the potential for more capital appreciation. So if one of the advisors, based on getting to know who you are, prescribes, let's say, a dividend strategy, it's not going to keep up with the stock market in really, really good years. It's also going to likely outperform the stock market in really bad years. But it's akin to a doctor prescribing something for, let's say, a skin issue that you have, and then you see something on television, or you go talk to your neighbor that has, a toenail thing or whatever it is. They're different things. They're meant to do different. They have different purposes. They have different designs, and a lot of times, I think we have to be careful not misunderstanding the tools that we have and what their purpose is and how it fits into our overall plan and lifestyle and goals that we've communicated with what's going on in the news or what's going on in the marketplace. And this is one thing that we're actually working on here. So if you're a client, one of the things that we're working on, and it's been 6 months, and this is a very important thing to us, is making value more visible. Because we do so much behind the scenes from an income, a tax planning, an investment standpoint. We do so many things, but we haven't done a good job of making all of that value visible. So we're gonna come up with something for you probably in the next 2 to 3 months. We spent a lot of time on this, and I think you're all going to be really, really happy. But there's so much that goes into it, and just one of those things that you said there just kind of triggered that rant for me, because there's a prescription for what you've said is most important to you. We always want to anchor back to that, and sometimes that prescription, which serves you, we feel the best, it may do really, really well based on what the market's doing. It may do a little bit less than what the market's doing, but when the market's doing poorly, it may do really, really well. So I think I've made the point kind of clear there, and that's important. So the winner for the last giveaway, and then I will throw it to Charles for his last word because I took most of his time there, James Coriali. So James, we want to thank you very much for registering for this last giveaway, and for all of you who have stayed here and went through this with us, I want to thank you very, very much. Charles, the man of many words, I'm sure has a lot to say right here. To close us out.
I'm just going to try and make sure the team is focused on doing what we're supposed to do, make sure that we all remain intellectually curious, open to new information. It's always changing, and willing to pivot.
We have something special that we're going to drop here pretty soon. It's so we did an extensive interview with these guys. We're creating a video series. We're creating some written material. So we have some really cool stuff coming out in the second half of this year. So if this is the first time tuning into a live stream, we welcome you to come back, subscribe to the channel, send us an email, let us know what we did right, let us know what we could do better. If you're a client, we really appreciate everything that you place in us in regards to your trust, and we're going to continue to work hard for you. So thank you very much. If there's anything we can do to help you, reach out to us. Otherwise, thank you for tuning in, and we'll see you next month.